All right. Good evening, everyone. Welcome back to our sixth edition of our monthly Wook Book Club. Just going to get our little disclaimer out of the way, even though I don't think we're going to talk too much about individual stocks tonight, but I do want to make sure we stay compliant. If I can find my little disclaimer. All right. So before we start talking about The Big Short, which I'm very excited for tonight's conversation, um, just want everyone to know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So, Joe, I see you got the tweet for The Big Short that you posted earlier pinned. If you could also pin the tweet with our balance of year book list, I think that would be helpful. Um, just to share. Um, too much stuff. Yeah, sorry, Joe. It's skipping my mind on what our next book is. Just wanted to remind people of
Yep,
that.
it's pinned.
Okay. Yeah, so The Big Short, I think it's great that we get to talk about this. It's April 2023. Last month, we just had one of the biggest banking flare ups in 15 years. So, I think it'll be great to talk about The Big Short. For next month, we've got Peter Lynch's One Up on Wall Street. And then you can see the balance of year reads, which are going to be subject to change. The Degenerate Generation is being written by Nathaniel Popper, who many of the members of our team have gotten the opportunity to know over the last few years. And uh, yeah, actually, I was talking to Nathaniel within the last week, and I guess he's decided to use my character as kind of one of the primary. I don't know if the word protagonist is the right word, but it's the main vector to tell the book's story through. So I'm intrigued to see that one, and I'll look forward to that. And I'm hopeful that we'll actually have Nathaniel able to join and participate in the discussion and hear about all his work on building out the story. So that'll be retail investor, GameStop oriented, and that'll be some point later this year. But yeah, so this month, The Big Short. Fun personal fact: I had never read this book until the past few days. Actually, I was a laggard on getting my reading done. I had seen the movie for the first time the Sunday night before the GameStop Mania week. So that was my little, I guess, hype video for myself. So I'd seen the movie, which is fantastic, and now for the first time read the book, and I could definitely appreciate it in a way that I couldn't having only seen the movie. But I would highly recommend both the movie and the book actually to anybody. And I think it's probably best served reading the book first if you haven't yet seen the movie, but both are excellent. So before we maybe go into any detail, I'll go around the Wook panel, and again for anyone who joins or is listening, this is going to be open. If anybody wants to chime in on the book, you're welcome to. You don't need to be part of our team to be part of the discussion. Otherwise, if you want to just listen in, please feel free. So. That's my backstory on The Big Short. Before we get into the meat of it, I'll hand the mic over to Joe. Maybe share your experience with the movie, the book, uh, and then go to JP and John.
Yeah, this is my first time reading the book this past month. I had seen the movie years ago. Like, I can't even remember. I'm shocked to hear I watched it before Rod. but I watched it, I want to say, um, at least 5 years ago, and loved it. It's really one of those movies that I think gets a lot of people interested in finance. It has that, like, that story that really brings out like the contrarian in everyone and makes people root for someone. I mean, look, they're making money off people losing their homes, right? It's a very dark tale, but you really do end up siding with those contrarians, and that's part of what makes it makes it a great story. Everyone draws the GME parallels as well, of course, um, but again, yeah, it's just one of those stories that really got me interested in finance. I'm glad to have now you know done the book as well, which is pretty much the same. Personally, I think I prefer the movie, but curious what everyone else thinks.
Yeah, no, I thought it was really good. I agree with you, Joe. A lot of the things what Joe said, I'm on board with that. And what I did love about the book and the movie is that they put in very easy terms and easy way for you to understand some of these, like what CDOs are, credit default swaps, mortgage-backed securities, and stuff like that, and paint it in a way where you know exactly what's going on and what they're doing. So it was really good, and it also resonated a little bit more because there's the GME story that we've all been a part of, and um, it was very entertaining because there were some common themes there, and um, that was pretty fun to watch and read about. So yeah, well, all in all, it was entertaining. But to go against the American economy, like you said, there was a lot of people that got hurt from this, losing their home, feeding their family, et cetera, et cetera. But um, yeah, it definitely got me more interested in finance and trying to find that contrarian stock or whatever we can invest in. There's always opportunity. So yeah, it was good.
John, before I get into the content, you want to share a few thoughts on the book and movie?
I guess I just want to spit it back to you. I know you saw the movie. Do you think it was accurate based on the movie and based on how Lewis portrayed it in his book?
I think it was pretty accurate. Uh, I definitely even I like Steve Carell's Steve Eisman character even more, having read the book uh, now. um, and I think have a little bit of a better appreciation for Burry in the way that Lewis kind of shared his backstory, his coming to realize that he has Asperger's, and that it wasn't just a function of him having a glass eye that made him the way that he is. But I think Lewis actually does a really excellent job in the early chapters of giving us some of that backstory into these characters in a way that the movie, look, the movie's well acted. Clearly, everyone loves. Uh, Geez, I can't remember the actor's name. The guy who plays Michael Burry. Um, I have to Google it now. I know it's a famous actor. I just don't care about actors and actresses. Christian Bale, that's it. So yeah, I actually prefer these characters from the book. Like I enjoyed these characters in the movie, and they were well acted in. But yeah, they're just something. Michael Lewis does a fantastic job of giving us their backstory. So I'll take that then as a logical segue. To kind of talk maybe a little bit about some of the characters in the book. And I did pin, so Steve Eisman was still in markets. He's still a well-known guy. He actually was in the Odd Lots podcast from a couple months ago. So I pinned Joe Weisenthal's tweet for his discussion, and in that one, Steve's talking about his skepticism around Bitcoin and all things cryptocurrency related. Um, you know, I really enjoyed Eisman's character. I think if I like, yeah, I understand why people might be drawn to Burry. I like Eisman a lot too. Um, you know, I know that this discussion is a little different because we're not really talking about an investment book. We're more so talking about the people, some of the main figures who successfully participated on the short side of the housing bubble, through these exotic securities, these synthetic collateralized debt obligations, which they were purchasing credit default swaps, CDS. So, like, I don't want to talk too much about the wonky finance acronyms and all that stuff, but it was interesting hearing Eisman kind of that he grew up in as an analyst on the street, and he started learning about this industry on the back of, and we talked about when we did the margin of safety discussion, right? We talked about how in the 80s you had junk bonds kind of come from nowhere and become a thing, and this kind of picks up with Eisman in the 90s, kind of on the back of all this like sliver of finance that's really really nasty in some way, in that it's like these financiers who are effectively. I'll read a snippet from chapter 1. So there's a sentence that talks about free checking accounts, your innocuous free checking accounts, being an example of how the financial services industry, the system is structured in a way to, quote, fuck the poor, and that Wall Street doesn't give a shit what it sells, unquote. And in that case, it's talking about free checking, where it's like, okay, yeah, free checking account, you don't pay a monthly fee, but the banks, up until a lot of the reforms after the GFC, were making oodles of money on the overdraft fees, the non-sufficient funds fees, all of the ancillary fee income that they were generating off of these quote unquote free checking products. And Eisman definitely looks at things through a bit of a pessimistic lens, with the assumption that Wall Street actors are not the best. The best, I guess is a nice way to put it. So I don't know. Here's one quote I copied from Eisman's kind of intro chapter. Quote: "He's sort of a prick in a way, but he's smart and honest and fearless." And yeah, I don't know. What did you guys think of Eisman?
Yeah, I do agree. But Burry is the fan favorite. I mean, Burry came out of this story with such a name in the world of finance. But Eisman, he has that charm, especially his language, his bluntness that I really like. I appreciate that. Burry's a bit more of the the autist side, and Eisman is the angry one. But I prefer Eisman's story as well. But I never really hear about him. When you look at the media, you see like what Burry said recently. He's got his Twitter account where he deletes everything he posts. And Eisman, you don't really hear too much of.
We'll get to Burry in a second. I actually, again, as I hadn't read the book until this month, I hadn't. I'd heard snippets of his backstory and his medical upbringing, so it was nice for me to understand how he came to get into into the seat at Scion. And I don't know. So I guess JP, John, what about Eisman? Were there any things about Eisman that really stuck out to you in a good way, in a bad way, or anyone else? Ted, I saw you came up. Would love to hear what you think.
I mean, yeah, I mean, he was a likable character for me. I mean, he was very smart and he was super blunt, straight to the point, and he was, I mean, he was a very respected guy in the financial industry, seems so. And he was trying to do the right thing. He was a moral guy trying to do the ethical thing. But at the end of the day, he didn't feel so good about pretty much being the same person that he didn't want to be. But I mean, yeah, I liked him. He seemed like a cool guy. Yeah.
I just threw a pin up in the nest of Eisman claiming that today's bank turmoil is nowhere close to a repeat of the '08 crisis. This was an article put out about a month ago to the day, and you can read that interview with CNBC if you'd like. But he says, put this way, when JP Morgan goes down, planet Earth burns. When First Republic, if it were to go down, it's a problem, but it's a handleable problem. So there's a good little interview to read on him if you're more interested in that.
I guess,
Hey, Rod.
Rod, did you feel like, he didn't feel very good about, destroying, like, the whole American economy collapsing? Because, I mean, at the end of the day, he was right, but he felt bad. Like, did you feel anything like that with GameStop or anything like that? Or are we jumping the gun with the questions about something
Yeah,
else?
probably jumping the gun a little bit. Ted, John, you guys want to chime in on Eisman?
Yeah, Rod. Thank you for bringing me up. I don't know if you can hear me or not. Can you hear me? All right, cool. Yeah, I mean, I guess going back to the beginning of the chapter, right, when they first introduce him, um, his background is obviously different from Burry in that like his career was basically built around covering subprime lenders, right? So I guess, just given his background very different from Burry in that sense. Um, But yeah, I guess like, in the chapter, like he called out fraud. I think it was twice, right? Like first at Oppenheimer, and then after that at Chilton. I think in the case of Oppenheimer, he joined right after being a corporate lawyer. They gave him coverage of those two banks. I think the first one was Ames and the second one was Lomas. Um, and yeah, I think one of the first things he did when he started covering Lomas was to downgrade it to sell. So I think the way that the book describes it is
Yep.
if you're bullish on Wall Street and you're right, if you're bullish and you're wrong, you get to keep your job, but if you're bearish and wrong, you lose it. So he like in a way kind of staked his name right on that call. And then later on, I think Moody's started to release and publish a data set, right, on the lenders, right? And it showed like overall stats on the loan book. And him and his partner, Vincent Daniel, at that point, I guess they downgraded the whole sector because, at the loan pool level, a lot of the stats were deteriorating. So yeah, he had that call too, and then you fast forward to Chilton, and the name of the company is evading me. I could find it, but yeah, so this is now I guess in early 2002, right? So he was at Oppenheimer in the '90s, and then after downgrading the sector. There was, I guess, like a year after he downgraded the sector, Russia defaulted, and I think long-term capital management blew up. And then, in the wake of that, the companies that he downgraded couldn't get capital, and they basically all went bankrupt. And then a few years after that, he went to Chilton, and there was kind of like a large company in the subprime space, right, that had been around for like a long time. And he basically identified fraud there. So like, even before 2008, right, there were a couple of cases where he kind of called fraud and kind of saw things blowing up right before 2008 that I thought was interesting.
Yeah. So I'll read the quote from his famed, what was it? It was, oh, let me get to the right page. I was just there. Okay. So From Eisman. This is Eisman's quote of himself from the book. The single greatest line I ever wrote as an analyst, says Eisman, was after Lomas said they were hedged. And this is a financial institution that participated in the subprime. And the quote was, "The Lomas Financial Corporation is a perfectly hedged financial institution. It loses money in every conceivable interest rate environment." I enjoyed writing that sentence more than any sentence I ever wrote. Those are his words. And then a few months after that was published, the company returned to bankruptcy. So, thanks to Ted for some of the different, examples. That one I think is just really great. It's kind of like I take it as you've got someone who did things in his own way. It was kind of against the grain, maybe, of what people in his shoes would normally do, and that's just how he, from the at least how his wife and others explained, that's just how he was. He wasn't rude for the sake of being rude, or a jerk or whatever. That's just how he was. I enjoyed the story of him kind of picking the brain of the CDO manager in the Vegas uh, conference that they attend, as well as kind of his outbursts at a couple of the different presentations. I mean, clearly this is a guy who could not care less what you think, who's going to do his own work, come up with what he thinks, and more often than not, it seems, be pretty darn right about it. I have a lot of respect for that kind of person. And again, the Eisman character, of course, is the Steve Carell character from the movie. Um, but okay, I think everybody likes Burry the most, or many people like Burry who maybe hadn't gone into the weeds on it. But I really did enjoy getting to know actually about Burry's kind of backstory and how just incredibly active he was on the early days of the internet, and posting on these message boards and having his blog, and just really being willing to go hunt anywhere and everywhere. It was cool to kind of hear. We obviously just did the little book that beats the market, so it was funny, to hear. And I'd not realized that Gotham Capital, Greenblatt's fund, invested in Burry early on in Scion. So that was something I had not known. I also thought it was interesting, at least from the book. I don't know if this is still true, that Scion's pricing, he only charged actual expenses as opposed to, say, 1 or 2% of assets under management, and then whatever performance above that, which I don't think the book explained. So I mean, definitely a lot of stuff from Burry. Him going to medical school and basically deciding that he much more liked the world of investments than medicine. There's just a whole lot of interesting stuff about Burry. And I'm looking at my notes. My favorite, I think, line is from one of his investors, quote, "That was a classic Mike Burry trade," referring to this Avant, where he had bought it initially at $12 and he kept buying it all the way down to $2, and then it got taken out a few months later for $22. And the quote is, "That was a classic Mike Burry trade. It goes up by 10 times, but first it goes down by half." And it stung me personally, because I feel like a lot of the time I feel like that. Maybe not as many of the 10x parts, but certainly the going down at first.
Hey, Rod.
Yeah.
Yeah, just a quick point on that 2% fee, because I thought that was interesting too. I just wanted to draw a quick comparison between that and the CDO manager that Eisman
Right.
had, because I thought that they're two opposite sides, right? Like Burry, he doesn't collect the 2% fee that most funds take for granted. Wing Chao is basically trying to just accumulate as much assets under management to collect a bigger fee. Um, and like yeah, and then like in terms of like the kinds of I guess like their like horizon, Burry takes like a longer term view, more patient. I think the way that the book describes it um, is that when Burry goes out right to raise capital, he tells investors that he's going to need their money for like at least a year or two because he's making unpopular bets, right? Either unpopular or underappreciated. Whereas in the case of Wing Chao, right, it's like really short term oriented. Not really caring about the investor, not wanting to do the right thing for his
And Wang
investors.
Chao
So
is
yeah,
I think, a very good characterization of the vast majority of the participants in the financial services industry. It's not like he's just the one bad dude. Most of the people, when they kind of lay out the landscape of who's attending that Vegas, event, it's just incredible, and it's hard, I think, for us, maybe who weren't like in the workforce or in like I graduated undergrad in 2010, so I was in undergrad when all of this was happening, and I was following it. I have an accounting undergraduate degree, so I was interested in all this stuff. But I feel like it's just different, right? To have lived maybe as a consumer who was a grown adult, like during the mid 2000s, because I do remember how incredible like a lot of the housing statistics were at that time, and um, it just like the core thing that I take away from this is that the industry itself was just so like structurally had the wrong incentives. Like the incentives were, for the Wayne Chows of the world to just keep accumulating assets and get more fees. If you're producing CDOs, you need to just keep making more and take your whatever cut, and you really don't care about anything because the credit reporting agencies kind of have your back. And it all seemed to hinge on the credit reporting agency process just being broken and taken advantage of.
yeah. I mean, on the topic of incentives, there was I forgot the page. I'm trying to find it here in my notes, but there was a page that basically mentioned Munger giving a speech at Harvard Business
Yep.
School, and right, like in the speech, he basically focused on incentives, and Munger said that if you know someone's incentives, you could tell a lot about them. And the book didn't draw the explicit connection from Munger's speech to just like the broader theme of incentives in the book, but there's obviously a lot of parallels there.
Yeah, I'll read the Munger quote. So I've heard this one a few times, and this is in a speech that he gave to Harvard Business School in the mid 90s. The line is, quote, at least this is after he kind of talked about some different examples of corporate kind of incentive driving outcomes. And he said, quote, well, you can say everyone knows that. I think I've been in the top 5% of my age cohort all my life in understanding the power of incentives. And all my life I've underestimated it. And never a year passes, but I get some surprise that pushes my limit a little farther. And I mean that's just such a vital aspect of this whole book, and then of what happened is that you had a lot of really poorly aligned incentives, or incentives that were not maybe aligned in a way that you would want to actually be. That most people were just willing to go along for the ride because of it aligned with their incentives, and they didn't want to rock the boat. And the protagonists, by and large, in the story are the people who are willing to dig a little bit deeper and maybe a little more willing to rock the boat when we think about the Eisman and Burrys of the world. There's one other from the Burry kind of intro chapter 2. There's one other thing I had put in my notes was as we think about us having this conversation in April 23, where depending on who you ask, either we're still in the midst of some super bubble if you ask Mr. Grantham, or people could point to some of the things going on in 2021, in 2020 as bubble-like behaviors. But there was the quote where there are specific identifiers that are entirely recognizable during the bubble's inflation. One hallmark of mania is the rapid rise in the incidence and complexity of fraud. And it goes on to note that the FBI reported that mortgage-related fraud was up fivefold since 2000, and this was in the mid-2000s. So just trying to think about today, right? You have so many different fraudulent type or schemes that just don't seem right, whether it's crypto, whether it's the de-SPAC bubble, and you kind of look at these people's incentives were, in the case of like the SPAC promoters, were to say the most outlandishly positive things they could to get the highest possible valuation, to get the biggest cut for themselves, yada yada. And it does go back to the incentives, but definitely there was just so much fraud, from like PPP to crypto to that right there with the SPACs, that clearly there's some corollaries to draw, I think, from 06, 7, 8 to maybe the past couple of years. I don't know what you guys think.
Yeah, I guess on the topic of fraud, I guess Buffett has a quote. He says that you can't. He says that you get to see who's swimming naked when the tide pulls back, and when markets turn, I guess you get to see the weakest hands first, and that typically tends to be the people committing fraud, right? So it's going back, I guess, to last year. With crypto, you saw it with FTX, and I guess that's a prime example. Yeah.
Yeah, I mean, FTX is a perfect example. You had, it's funny, I saw reporting within the last week that Taylor Swift, ironically enough, was one of the only people who really actually did enough due diligence, pushed back on the whole thing. But so many others, I feel like, just like with the whole subprime bubble, where people were just going along with it, everyone was doing it. It was let's make money off of it. With FTX, people saw other people investing in it. Let's do it. We don't want to miss out. People more concerned about missing out on gains than on prospective losses, and I think there's probably some corollary there between the sentiments of markets in raging bull markets and bubbly like markets versus you don't have as much of that going on in 09, 10, 11, I think. And perhaps we won't have as much of that going on in the coming years, but remains to be seen if we're out of the woods.
Yeah, and I guess somewhat related to the topic of fraud, I guess in the midst of a bull market, I think people tend to turn a blind eye to risk, and to relate it to the book, a lot of the loans, right, that were being made, pre 2008, right, going back, probably to as far back as 2003, certainly in 2004, 2005, the percentage of loans, right, it's on page 27. There's a blurb at the very beginning of chapter 2, just turning a blind eye to risk, right? The percentage of loans in these loan pools, right, that we're feeding into the subprime mortgage bonds, the percentage of adjustable rate mortgages, and just
Yeah, that was something I
just
jotted down.
the
It was
degree of risk just building over
65%
time.
fixed rate in 1996, and it became 75% floating rate by 2005. And farther along in the book, there's I forget the name of the company, but it talks about a company who's basically writing these loans, and people are missing the first payment, right? So they're issuing these home loans, and the borrowers aren't even able to make the first payment, and it's like, what is even going on, right? If you're in an environment where you're lending tens, hundreds of thousands of dollars against a property to a borrower who, clearly the lending standards are night and day today versus then in terms of creditworthiness, documentation required, etc. And just kind of rereading that, having not again read the book and only having seen the movie, and like really appreciating just how horrific the lending standards were at that point in time, because right they were incentivized to produce these loans, not they weren't incentivized to produce good loans. They were incentivized to produce a lot of loans.
Yeah. I mean, there was a name for like a certain type of loan. It's at the bottom of page 27, top of 28. The pay option negatively amortizing adjustable rate mortgage, which is basically you don't pay any interest or principal, and you just continue to roll forward the interest into principal until presumably the person just defaults at the end. Yeah, I mean, typically for a person without a job, income, or assets, yeah.
Yeah, the example, I mean, of which there were many, but going back to the Vegas, when they were in Vegas, how what was it, a friend of Danny's, one of Eisman's guys, returned from a night on the town to report he'd met a stripper with 5 separate home equity loans. And I know in the movie they
I
show
remember that part from the
in the
movie.
movie they're down in Miami, I think, and similarly, it's like people bragging about these things. And it's funny that the book also cites Eisman, I think his former, not nurse, two people close to him that he used to hire, who had themselves kind of been swindled into this whole thing, and one of them ended up owning like a half dozen properties in Queens that I think the book implied she ended up losing everything. And it's tough because the human story, right? There's so many people that were harmed. There were a lot of people who were harmed that, right? It's like who's the victim? If you're going along as a willing party in these contracts, I mean, clearly there was wrongdoing by the lenders, wrongdoing by maybe the regulators, uh, and then you got to put some fault on the borrowers, but it definitely was a house of cards that eventually collapsed on itself.
Yeah, I mean, in terms of putting blame on the borrower, I think like somewhere in Burry's chapter, I think there's a quote from Burry, and he addresses that. He says that from the borrower's perspective, they're always going to want more for themselves. It's like when the lender kind of loses their cool and takes on too much risk, like that's when it becomes a really big problem, because both the borrower and the lender aren't considering the risks uh, involved.
Yep. So let's think. We talked about Eisman, Burry. Lippmann is an interesting character. uh, the Deutsche Bank trader who kind of finds himself, I guess. I mean, in a sense, like later in the book, we kind of come to find out that there's several dozen, couple hundred, maybe people who ended up buying these uh, credit default swaps from him, including some of the big winners. Paulson is well known. The but he's interesting because it's like he reminds me. I'm trying to think of the name of the character from the recent Star Wars movie. The guy who just doesn't care. He'll go to whoever's gonna give him the most money. Like he's just your unbridled like Wall Street trader. He is just trying to make money. He knows he's kind of shady. Um, and like what was bonkers to me was the fact that like Goldman was able to take these massive cuts of these transactions. So like they were writing the credit default swaps, which were being sold. Um, the CDOs were being sold to AIG, and it's like they were paying hardly anything, and then the buyer of the credit default swaps was paying 200 whatever basis points, and it was just this massive spread that the traders like Lipman and others were able to take through this whole process. Which I'll be honest, having never worked in on Wall Street in the industry formally, it was just very eye opening to kind of hear and see kind of like just how the conversations between the parties work when you're dealing with these what is it, the ISDA, I forget what the acronym stands for, but once you're like a professional trader, investor, whatever, and you're dealing with these big entities, and really it's like it goes back to what Eisman and co were kind of like saying, because they met with Lippman a bunch of times, and it's like we're just trying to figure out how this guy's screwing us. Like, that was part of the reason why they kept bringing him back. They just couldn't wrap their head around what was going on.
Yeah, I mean, that was something that stood out to me too, and I think it's just because of just like the complexities in the bond market. Because like, Eisman and his team, they're stock market guys, right? So when Lippman came in and pitched them on the credit default swap, I think that they didn't trust him because of kind of all the complexity with bonds, and it's not an opaque market. And when it comes to pricing, like based on the way that the book describes it, like um, you could like wind up getting screwed in terms of the pricing. So like they didn't trust him, I think, like from that perspective, right? Just like the complexities of the bond market. Eisman though seemed to like his pitch. He was like, great guy.
There was a line referring to the skepticism around Lippman, the trader from Eisman's office. Uh, quote, Moses could have walked in the door, and if he said he came from fixed income, Vinny wouldn't have trusted him. Yeah, I mean, it's a huge market, the bond market, and just the lack of, I guess, visibility for many. Like I know so little about it, and in fact, just so much of this happens. At least again, from when the book was written, I don't know how different it is today versus then, but the book kind of talks about a few times where the salesperson, would be calling on a cell phone as opposed to their office line, so that they could, have non-recorded conversations. And the implication, I think, in the book at many times, that there's so much flexibility into the price when it came to these different, rather esoteric instruments, right? Like you had it where like later as the book, as you're like getting closer to the crescendo of everything, all the shit hitting the fan, and you're into like 2007, it's like things are starting to fail, and it's like they'd be like, yeah, I want to buy it for whatever, risk free plus 100, and they'll be like, oh no, we'll do it at risk free plus 200, and then just be kind of negotiating the transactions over the phone. It's like, I guess I just took for granted, just quite how when you're dealing with stuff that's not a security listed on an exchange with a lot of liquidity, it really is just that simple, that it's whatever you're willing to sell it for and whatever I'm willing to buy it for, and can we make a deal or not?
Yep. And then like once the trade like panned out, um, the banks, they didn't start to mark the
Right.
CDSs, right, in their favor until, they got on the same side as them, right? The banks basically like coordinated, the pricing when it came to the CDSs.
Yeah, and Burry was, I mean, he was pretty darn close to potentially having to close up shop because the book talks about he, he got into this in 2005, and as '05, '06, and '07 were going along, he was losing a lot of money. And even though the fund was still up, massively and had fantastic performance in the preceding several years, it really just went to show how short-sighted, or rather, how short investors' memories are. And they didn't all the good things that they had to say about him or thought about him and felt about him during his time of successfully investing throughout the early 2000s. Uh, and they didn't care at all when he was doing something that they didn't necessarily understand. They didn't. They lost faith, I guess, in him, and then he kind of had to pull out all the stops to retain the capital. And what was it, the side pocket that
Yeah.
he deployed? But it's just really, when you think something that is contrary to what everyone else is thinking, you need to be prepared to bear some vitriol, and it's going to be especially hard if you're managing other people's money.
Yeah, I mean, for Burry too, it was like he was, yeah, uh, before the trade panned out, right? Like, he had a great track record, but I guess because he put on the trade, first, right? He was the first one to do it, back in, I guess, maybe 2003. It sounded like was when he first started to dig in, and then by 2004, 2005, at that point, he was the catalyst behind the creation of the
Right.
CDS on
The
subprime
product didn't
mortgage
exist
bonds, right?
until he came around and wanted them
It,
to make it.
yeah, exactly, right. So it's like, he was early, but he was really smart about it too, because he locked in the trade early, basically guaranteed himself and the fund losses, um, from 2005 until 2007, 2008. But he knew, like, once these teaser rates expire and the rates reset higher, people are going to default, en masse, right? So he spent time looking into kind of the worst triple B bonds, triple B subprime mortgage-backed bonds, the ones with the highest floating rates, no doc loans, right? And he placed his bets, really intelligently. He was the first one to do it, locked in losses, but I guess it was better to be early and right than to be late and not be able to put on the trade, because the way that he was thinking about it is if he drags his feet and he takes too long, at that point the market could see it, right? And then pricing will be completely different and he wouldn't be able to put on the trade. So he was like, you know what, better to be early. Yeah.
Yep, for sure.
And like apart from that too, like the CDS was almost like the perfect instrument, right? Like you didn't have to go out and short a stock of a tangential company,
The most,
right, that can continue to trade up.
yeah, the most just incredible. You're right. So yeah, exactly. You're not short, right? You're laying out capital, and your upside is many multiples, and your downside is the capital you're laying out. It's not like you could get destroyed if it moves against you or is flat. Or I guess if you're a short seller, your risk is of course theoretically unlimited. And Burry, as is noted in the book, is not doesn't pursue short selling. He kind of has a bias toward preferring, fundamentally being long. But That's a really good point. And in that vein, that reminds me of chapter 5, the guys who, found out about the power of options, and in particular about how incredible options can be when the market is not pricing things properly. So the Cornwall Capital guys who the example that they start off with is a situation with Capital One where it's either, the company is either a fraud or not, I guess, is kind of what it distills down to. And it's like, okay, either equity is a zero or it's going to 60 or 50, whatever. And the shares were trading at, I think, 20 or 30. And these guys saw that they could buy, a 1 year out $50 strike call option for $3. And that I enjoyed that chapter, just kind of highlighting all these different asymmetric trades that they pursued and ended up succeeding on. And fortunately for them, it seemed like they got lucky early, in addition to, I'm sure, being, doing their due diligence. But they rapidly built the fund up. It was really interesting to hear their story about the challenges they had just trying to, as a tens of millions of dollars shop, get treated, at the big boys table and be allowed to act like a grown up fund, if you will. But yeah, that's a good example, because the CDO was a great, or the CDS, excuse me, was a great instrument for what you were saying. And then I think it was nice to kind of get their experience with options, and obviously they ended up putting the swaps on for the double leg, the higher rated tranches that cost even less. But it was like, well, if they're all shit, then let's, we can get 4 times as much exposure by getting exposure to these triple and double A rated CDOs relative to, paying 4 times as much for the triple Bs. So I enjoyed their story, and yeah.
Yeah, I mean, the thing with the CDS too is like there's like significant leverage in it, right? So like if going through it, like for like, each of the firms, each of the characters, right? Burry's case, Cornwall's case, Eisman's case, like the book would compare the size of the fund to the size of the short position, and in every single case the size of the short position was bigger than the fund.
Right.
And it goes back to how, like, with a CDS, you're basically just paying the premium, but that premium ensures a much larger size of subprime mortgage bonds, right? So for round numbers, in Burry's case, right, let's just say, like, if he's buying CDSs on $100 million worth of triple Bs, it said that the premiums on that are 2%, right? So that's
Yep.
$2 million a year, but the upside on that 2 million is 100 million, right? So it really amplifies the the bet, right? The size
Yeah,
of
50 times return if it had paid in that 1 year, right? Yeah, I'm going to read a little sliver from the book on that. So this is Burry. So this is on August 31st, 07. Burry lifted the side pocket. He began selling his own credit default swaps. His investors could have their money back. There was now more than twice as much of it as they had given to him. To what you just said, Ted, just a few months earlier, Burry was being offered 200 basis points or 2% of the principal for his credit default swaps, which had peaked at 1.9 billion. Now he was being offered 75, 80, 85 points by Wall Street firms desperate to cushion their fall. At the end of the quarter, he'd report that the fund was up more than 100%. By the end of the year, in a portfolio of less than 550 million, he would have realized profits of more than 720 million. And I enjoyed this part. Still, he heard not a peep from his investors, and these were the investors who were just a few months earlier haranguing him about getting their money out. Quote, even when it was clear it was a big year and I was proven right, there was no triumph in it. He said making money was nothing like I thought it would be. To his founding investor, Gotham Capital, he shot off an unsolicited email that only said, "You're welcome." He'd already decided to kick them out of the fund and insist that they sell their stake in the business. When they asked him to suggest a price, he replied, "How about you keep the tens of millions you nearly prevented me from earning for you last year and we call it even?"
wow. crazy. I mean, it's crazy because like that, like Gotham was, basically, gave him his shot, right?
Yeah.
Like, I think the way that like the book described it is like Burry saw Greenblatt as like his godfather.
I see Brian was sharing a few comments. So yeah, the quote from Ben Hockett, who worked with the Cornwall guys, that quote, financial options were systematically mispriced. The market often underestimated the likelihood of extreme moves in prices. This reminds me of GameStop in 2020 when, and I mean, it could even be a 19, but of course, Roaring Kitty, Keith Gill famously was, buying these, what were at the time deep out of the money calls for, literally a few pennies a piece in premium. And that's just the power of when things move so significantly, right? He saw tens of thousand plus percent returns on those positions, um, and you know I remember the volatility that was priced was like 100 whatever, let's call it 110 120%. Okay, great. But when the price was already like at, let's say, $3, and it's like, okay, yeah, so that implied vol, you need, if you say bought a $6-ish strike, you basically need it to move kind of as what was priced in the direction you wanted, by the time you wanted to break even. But in that case, obviously the stock, from those extreme levels, re-rated meaningfully. And yeah, I think that was something that I saw firsthand, that the options were systematically mispriced. It's obviously not from '07, but from now. And then Brian had shared also the lines, yeah, that he highlighted what you were sharing, Ted, about the interest only, negative amortizing, adjustable rate, subprimes. And yeah, you want to watch the lenders, not the borrowers. Yeah, that was a little earlier. So that agreed with kind of your takes there. But that's it, right? If you can find systematically mispriced derivative securities, you can make a lot of money if you're able to get into them when the mispricing is that extreme. As clearly these securities all were, with hindsight, with the benefit of hindsight.
Yeah, and to go back to Greenblatt, I think White Mountain, something very similar happened with them. So Greenblatt was the first investor. White Mountain was the second, and I think White Mountain called out Burry as being unable to predict global macro events. And Burry's response was that he tries to find value, right? Like it's not a matter of like predicting a macro event. The data was there, right? And the data was telling him something. So he was interpreting that. But it goes back to what you were just saying about underpriced or mispriced uh, derivatives.
If anyone who's listening wants to chime in, you're welcome to request to speak. It's a little after 9. We're going for about an hour talking about The Big Short by Michael Lewis. I think we'll keep going probably for another 15, 30. Let's see. It's really crazy. Again, I'm looking at chapter 8 when Burry discovers that he and his son have Asperger's. Like, it's wild to think, and I guess it's not that weird. Maybe at the time, you would think, and maybe today, that sort of thing that diagnosis might get made in youth. But it's just, again, it's I don't know. I just thought it was wild to think that he lived with that condition he was born with, thought it was one thing, but took many, many, many years for him to find that out. And only because his son had it and was diagnosed with it.
Another thing too that I found very interesting about the book, because very similar to you, I saw the movie before reading the book. This was my first time reading it. Just like the whole concept behind a synthetic CDO, like I did it, like that was something that I've heard of before, and I was like vaguely familiar with what it. So I knew what a CDO was, but not a synthetic CDO. And reading this book kind of in a way, like I wouldn't have looked into it without it, but just the whole concept behind a synthetic CDO was like absolutely wild. And that being kind of like one of the reasons why, the crisis, right? Like the problem with these subprime securities became so large and so big, right? Like, I don't know if you would want to talk about that. I just found it very, very interesting. Like,
Yeah.
just like what like a synthetic CDO is.
Yeah. Let me just read a snippet then from that section. So, I think where you were getting at it with is more securities were able to be created because of this synthetic CDO than the underlying home loan activity would otherwise have permitted. So, quote, and so to generate $1 billion in BBB rated subprime mortgage bonds, Goldman Sachs did not need to originate $50 billion in home loans. They simply needed I just got muted. Basically, people had no due diligence, had done no due diligence, just buying based on their ratings agencies. Whatever the ratings agency slapped on it, they were slapping these AAA top rated levels on what was just a pile of dog shit. And because Moody's and S&P said so, people, pension funds, insert name here, were willing and able to buy them. And frankly, many of them didn't care. All they cared about was those three letters.
I mean, I can think of a few different markets where the amount of, I guess, contracts or these, structured products, the notional value is much higher than the total amount of the underlying asset. I think one good example is gold. You have like COMEX and the London Metals Exchange. In that situation, you have a lot more contracts than the actual gold being delivered. And I guess another one is GameStop. Options, right? There was so many call options purchased in 2020 and 2021. So I guess I do hear this, sort of thing, right, where people say, "Oh, there was so much leverage and stuff," but I guess, is that itself a reason? I don't know. What are your thoughts about this?
Well, I mean, it made this a hell of a lot worse than it would have otherwise been.
Mm-hmm.
I mean, it's a factor, right? But there's you can go a little deeper than that on why people are able to be leveraged in the first place. So it's kind of actually when I read the book, it was less about the personalities, but the way he kind of explained the more intricate and technical details in a way that it's easy to understand. And I think the movie did too, on why everything occurred as it did. Um, Again, it's a bit technical, but the very long short story, I suppose, would be that all the incentives were in the wrong place, right? It was a system in which you were continually able to, uh, sorry, but a bit of a cough, continually able to pass the risk on someone else, and then make money off the commissions after you do that. Um, so when you have a system like that, then people are going to be incentivized to use leverage because you're not really taking on the risk yourself when you do it, right? Um, I mean, a good example would be when they were taking on mortgages at the time. Um, they would take them off, they would sell it to the banks. So the guy who found the mortgages in the first place weren't taking much of the risk, anyways. And as for the banks, they're not really taking a risk of the mortgages going default. I mean, there's few circumstances that they are, but they ultimately pass it on to the end consumer, and so they're the ones that get screwed over. But the problem with the banks was it takes time to actually package all those loans, and they got so greedy to the point that they were holding them on their books for such a long time with all that leverage. Um, but they were only able to do so because of the fact that they were able to pass the risk to the next party in a lot of the cases. So I think leverage was definitely a factor, but I mean, if you were taking on the risk yourself completely, I don't think you would allow yourself to be levered that much in the first place. So, yeah, the whole system was broken at the time. So, a lot of regulations came forward after that, and yeah, hopefully, I mean, it's very unlikely something like that happens again in the same capacity.
There's there's another snippet from the book that reminded me of something that happened recently in chapter 7, talking about S&P's ratings models, assuming prices would only go up and that the model could not accept a negative number, which reminded me of oil in 2020, about 3 years ago. I know it was a couple days ago, it was the 3 year anniversary, right? Where the front month oil contract for physical delivery and Cushing, traded negative. And it was one of those things that a lot of people maybe thought would never or could never happen. And the whole thing, the whole housing market kind of subprime bubble was all really predicated on that reality or that belief that prices would only continue to go up and could not go down. And clearly, those are the sorts of things that it's usually a one-time thing, right? Like once you see the thing happen that you thought could never happen, then you're aware that it can happen. But that'd be the exciting one is trying to find the next thing that everyone assumes can't be true, right? That is that it does in fact prove itself out. All right, and we're coming up on 9:15, so I think we'll run till the bottom of the hour. Uh, JP, Joe, or are there any things we haven't gotten to talk about yet that you guys want to bring up?
No, I'd say you guys just about nailed it.
Okay. Same, to Chris and to Ted. I don't want to repeat ourselves and talk about stuff we already talked about, but there's definitely a lot of different things we could talk about. If you guys, I don't know if you guys wanted to bring anything else up.
I mean, Not really. I mean, I guess I would just be curious to hear your thoughts or anyone else's thoughts on, like, yeah, trying to draw comparisons between 2008 and, what we're currently seeing in regional banks. I mean, obviously it's
I mean, the
very, very
lending
different.
standards are night and day. I
Yeah.
think that's part of it. I think the consumer, in terms of how leveraged both the consumer and the financial institutions are, both are far less leveraged today than they were 15 to 20 years ago, right? After the great financial crisis, there was a big delevering cycle, and the consumer, chewed down its debt, both housing debt and revolving debt. And I just don't think that the underlying balance sheets of everybody in the mix are comparable to them. I do think that prices are clearly still at a very elevated level, and that's kind of, well, I don't think that we'll have something like 2008, right? But we could certainly see, and First Republic today, as perhaps maybe today was the opening of the eyes to people that after them losing all the deposits they reported yesterday, that company is not going to survive. And there's going to be more bank failures in all likelihood, right? But that doesn't mean that I guess, the underlying situation where there was a lot of shoddy lending standards, like that clearly hasn't been the case. Lending standards have remained pretty high. I think the issue more so becomes how high the prices of the underlying properties have gotten, and some of the negative effects of that. You don't have a mobile consumer. People can't move to where jobs are because they're stuck. They're trapped. They're house rich. And once prices start to go, like if you look at really any long-term chart, you can just kind of see that we're just coming off of another house price bubble, and of course each market varies. So I don't know. Like there's some comparisons in that prices got really high, but then there's a lot of differences.
Yeah. I mean, very different, of course. I feel like one of the lessons after 2008, right, from the Fed's perspective and from the government's perspective, was to act, as quickly as possible. And I feel like with,
They clearly learned their
SVB
lesson,
yeah.
and we. I don't mean to cut you off. I
No.
know you've listened to a lot of the stuff we talked about, but we definitely talked about that they acted very quickly, right? They were very. I mean, the bank failed Friday, and by Sunday night, they came out with this sweeping, coverage of all depositors, which that's a whole separate can of worms, I guess, that you could argue they opened, but they basically said we're not going to allow this to balloon into a Lehman-like moment. And I think that was, if 2008 hadn't happened, I do not think that they would have acted that promptly.
Yeah. And it was the same thing also with Credit Suisse, right? Like Credit Suisse happened the week afterwards, and I think it was the Saudi National Bank, or some Saudi fund that owned 9.9% of Credit Suisse, right? They were just under the 10% threshold, and Credit Suisse was in the beginning stages of also experiencing a run, and the Saudi fund that owned 9.9% was basically we're not going to up our investment, and they kind of made it sound like there was kind of a regulatory reason to not wanting to go above that 10%, but also saying it in a way where it's even if we wanted to go above that 10%,
Yeah,
we
that was
wouldn't
the
do it.
death knell for them.
Yeah, and it was the same thing, with in Switzerland, right? It was very quick too, right? Where within a weekend they basically orchestrated, UBS buying them, right? It was the same thing there.
Yeah, and the Swiss government had rules in place and plans in place, I think, from the 15 years ago that they otherwise it would be a much different conversation, I think, and we wouldn't have seen such swift resolutions. And in the case of UBS's shotgun marriage with Credit Suisse, right? The Swiss National Bank probably wouldn't have even had, like, they wouldn't have even had the legal framework in place for what ended up happening to transpire. So, it's a great reminder. Again, we obviously decided to have this book slotted into the book club. It's a little different than our other discussions, which have been more about more investing related and process related and the like. But I think that those are really good points. That what would 2023 crisis have looked like in lieu of the learnings and the actions taken 15 years ago. It clearly would have been worse, in my opinion, had '08 not happened and we just came to this.
Yeah. I mean, just like like my last and final thought would be, I mean, something like Bitcoin. Like, Bitcoin was something that I was very dismissive of for a very long time, and I remember being in college, hearing everyone talking about Bitcoin and Ethereum, and knowing what a stock is and what a bond is, but not knowing what cryptocurrency is, so just basically ignoring it. And I feel like in the aftermath of '08, the conversation is about the banks and the regulation, and the main actors, whether it be Bernanke or Geithner or um, Yellen, or but I feel like very, not as often, like if ever, you hear Bitcoin being talked about, um, and just talking from personal experience now, I guess this is now going back to 2001. China banned Bitcoin mining over the summer of 2021. At that point, Bitcoin was maybe like 60 to 70,000, and in a matter of a week, it got cut in half, and that kind of peaked that like opened the door for me wanting to learn like a little bit more about it, and um, relating it now to 2008. What interested me about Bitcoin and kind of the angle that I arrived at it at was kind of its connection to the financial crisis. Um, and I feel like, just like in general, when people talk about Bitcoin, like this connection is, not commonly made. It's, if you trace Bitcoin back, right? The white paper came out a month after Lehman collapsed and a month before quantitative easing one in November 2008. And if you compare Bitcoin to QE, um, Bitcoin is basically the opposite of what QE is. So if you think about QE, right, the Fed prints money, the cost of printing that money is zero, and the supply, in theory, is infinite, right? There's no cap on the amount of money a central bank can print. If you relate that to Bitcoin, there's an actual cost. You have to purchase the computer, you have to pay for the electricity, and the system credibly ensures a 21 million supply cap. Um, so I feel like when when I used to hear people talking about Bitcoin and describing it, it was always this high beta asset that was highly correlated, to tech and the Nasdaq, which is true, but it misses the point because the reason why that is because it's inextricably linked to QE, right? When the Fed is doing QE, by definition, Bitcoin's going to benefit from that because it was created as the antidote to QE.
Yeah, that's a great point. Also, just to touch on the topic of why this is different now than it was in '08, what we're dealing with now is they're very individual cases and very niche cases, especially when you see cases like SVB, that individually made bad decisions among the banks themselves. So they weren't like systematically linked to the point where it would affect an economic collapse like it did before. I mean, at that time, you had all the big banks involved to the point that you had normal people involved taking on these mortgages. But there's just a case of few bad apples that I think haven't made the best choices, especially with locking in those low interest rate bonds at the time that they did. So, yeah, I guess just reiterates the point that it's definitely not the same as before. Um, Probably not something systemic or nationwide.
Yeah. And I guess from like a learnings perspective, like on the back of that, I feel like the key learnings are going to be, I think, whether if it's the Fed or the government, there were certain regulations that were taken off the small and the mid-sized banks, in 2018, going back to the Trump administration. They were, they were put under a certain like deposit limit, right, or threshold. So something like this could have been seen if they were still within that regulatory framework. So from a lessons perspective, I feel like that, we're going to wind up going back to that or maybe something like that. And then yeah, trying like if you're a bank and you're taking uninsured deposits and buying long duration assets, from a regulator's perspective, I feel like the question is, if you're going to do that and you're going to hold them until maturity, you're going to have to prove to me that you are able to, you know, hold those until maturity. So yeah, I feel like those are kind of the key lessons from like a regulator's perspective on the back of this, and kind of the key questions that they're probably thinking through at the moment.
One of the other key things I'm also just kind of think about, how different would 06, 7, 8 have been if we had social media to the extent that we do now. And it clearly, the bank runs were, I don't know if the exacerbated is the right word, or even the direct cause of the bank runs was, social media, Slack channels, whatever, such that now in 2023 you can move financial assets with a couple thumb swipes, whereas in 2007 even mobile banking was still fairly nascent and social media was not as widespread as it is today. So that's another thing I'm curious what people think. Maybe that's a good one to go out on, in how different and what are some of the impacts of the widespread, I guess, ease at which information is disseminated, and it could be misinformation, um, relative to when this happened 15 years ago.
Yeah, I mean, I think it definitely, accelerates things, right? It gives, prominent people a platform that, to reach a lot more people than they otherwise wouldn't. And then, somewhat related to this, but like digital banking too, right? Instead of having to drive, physically to the bank to take out your cash, or if you're traveling in a different country, what have you, you could essentially withdraw your funds mobily from your phone. I feel like that kind of played a role in it too.
I think Twitter is kind of crazy because especially during the regional bank saga, you had like Twitter threads from VC guys who were like documenting their entire story, right? Like the guy was like, I found out that from this group chat that like everybody was taking their money out. And then I left my work and then went to like move my money out as soon as possible. And then he buys like I think the guy like bought like shares of SVB saying, oh, I think it's going to recover or whatever. But like, I think just in general, it's like really interesting to be able to see the story in like real time on social media, and you don't have to wait like 5 years later for someone to write a book about it. um
Yeah, I mean, and it probably arguably makes the problem worse because if you're on Twitter and you see something like that, even if your money is in a healthy bank, if you see that, you're not going to take the risk if you're above the um, insurance threshold. Yeah, so it probably doesn't help the situation.
I think even people who were below the threshold had maybe like 50, 100,000 took their money out just to avoid the headache.
Yeah.
Yeah, so it's not really good for people to do that. And I guess we have laws, at least in California, we have laws about like causing bank runs and stuff. But I don't know if they're going to get enforced or whatever. But yeah, I think legally, from a legal standpoint, it's going to be tough at this social media age and investing, especially since COVID, when a lot more people started investing in stocks, and politicians as well.
Yeah, and clearly with social media, people are much more willing and able to just simply follow what they see, what they perceive to be, the masses doing. And I know you're well familiar with, of course, the Bed Bath & Beyond saga, as that ticker is, as of today, finally will officially be delisted as of May 3rd. But yet the common equity, which of course will be worthless after the bankruptcy, is still, even now, worth over $100 million. And that is obviously a sad example, I think, of when the people can follow what they believe is good information and find themselves in a bad spot. But there's good, as you said, Chris, with the example, like you can follow along live, but there's also, I think, a lot of risk of whether it's purposeful misinformation or just um, inaccurate. It just adds to the noise that you have to try and work your way through as a enterprising investor to try and get as close to the truth as possible, and then place your bets accordingly. So with
I
that,
think, yeah. What are you gonna
no,
say?
go ahead. No, go ahead.
Oh, just saying, like in terms of like social media, like Reddit and like StockTwits and Twitter to some extent as well. Like you have these pools where people spread these conspiracy theories, and people idolize some people who have some theories, and they're not really founded by anything, but people have really strong emotions, so they kind of just trust. There's like a social trust element too, so it's a net negative, at least for the Bed Bath and Beyond situation. Social media was a very big net negative for that, because there was a lot of false information being promoted.
Yes, I think that's definitely a risk of this world, where there's just even more information being disseminated, and trying to suss out what is not false and what is accurate. It's just very difficult, can be difficult, can be time consuming. So, but when you can find those nuggets, of course, that is core to our Wook Capital Management thesis, that through effective crowdsourcing of research, we can uncover insightful nuggets of knowledge. And I think that there's, it's just a balancing act. There's obviously big pros and cons to it. It's just a different landscape today, with the reality of information traveling so much faster and money being able to travel so much faster. So it's been a great conversation, everyone, talking about The Big Short. And I think for most of us, many of us, the first time to actually read the book, even if we've seen the movie before. So really appreciate everybody for tuning in and participating in our discussion this evening. Just some programming notes, as you can see from the pinned thread or pinned tweets, we've got the balance of your book list coming up. So next month for May, which it is always on the last Tuesday of the month at 8 o'clock, for our book clubs, we'll be discussing Peter Lynch's One Up on Wall Street, another book that I've not read yet, so I look forward to reading that one. And you can catch the whole book list in the pins, as well as at Wook Capital handle. So book club will be at the end of May. This Friday we'll have our, is it number 30 this week, Joe? Our
I think it is.
30th Wook
It
and
is
Review.
30.
So we are grown-ups now. So we'll have our Wook and Review newsletter out Friday morning, as we do every week, and Friday at the close. If you'd like to join us, this week's topics will be around all of the earnings. This week in particular is really peak of earnings season. We've gotten a couple of big cap tech companies reporting today after hours. They reported. Google and Microsoft will discuss kind of the implications of where earnings season sits on Friday, the outlook, and also the debt ceiling kind of wonkiness, what's going on in the treasury bill markets with this, this thing that no one hopes could possibly happen, but that is a real risk it could happen. We'll talk a little bit about that on Friday, and among other things. So that'll be Friday for our Wook and Review. And then Wednesday night, so tomorrow night at 7, we'll be hosting our market open mic, which I'll be hosting on my @Rod Alsman, my personal handle. So please be sure to follow my handle as well as the @Wook Capital handle, so that you'll be able to get all of those programming bits as they come. So with that said, on behalf of the whole Wook Capital team, thank you for tuning in to our 6th edition of our Wook Book Club, covering The Big Short by Michael Lewis. We look forward to catching up with you soon, and hope everyone has a good rest of their evening. Thanks, everybody.
Thanks, guys.